I hope you are all staying healthy and safe and enjoying what is likely a summer we're not going to forget for some time. We're more than 6 weeks into the third quarter, and with fall approaching and with the Dow Jones, S&P, and NASDAQ at or near record highs, I'd like to share with you some of my thoughts for the outlook on the economy, stocks, interest rates, and the upcoming presidential and congressional election. If the first quarter for U.S. stocks was the worst on record, the second quarter through June 30th was among the best, with the sharpest gains since 1991. As we live our lives differently and have gone through a forced adoption of technology, NASDAQ has been the clear winner. Small cap stocks, represented by the Russell 2000, dropped the most in the first quarter, but rebounded more sharply than the S&P, given the index exposure to technology, which has also benefited from the forced adoption of technology, and healthcare, notably biotech and pharmaceutical companies. On healthcare, we're seeing the largest expansion of spending since the Affordable Care Act was put into law, and several small-cap biotech companies have benefited from government support to develop therapies and cures for COVID-19. In July, the strength in equities continued, and the S&P advanced by more than 5% for the month, with healthcare and technology companies outperforming banks, industrials, and energy companies. Earnings reports from a broad cross-section of companies in varying industries reported profits that were considerably better than analysts had predicted. This is astounding given that this is the quarter when our economy was essentially shut down for the entirety of the quarter. Management teams did a great job controlling expenses in an environment where demand was slow. The largest technology and healthcare companies did particularly well as they reported revenue and profit growth that was much better than had been feared by analysts. These financial results stood out dramatically despite the economy being in a deep recession. Many technology companies benefited from new opportunities in the stay-at-home, work-at-home economy, and healthcare companies working on cures and therapies to treat and manage the virus also did quite well. Though the equity indexes did well, many stocks did not participate in the rally. But new notable changes and trends began in July and continue today. Until July, many economically sensitive industrials, materials, banks, and consumer stocks in the S&P 500 and the Russell 2000 lagged in the recovery. However, on days when announcements on the progress for vaccines or drugs to treat the symptoms of COVID-19 occurred, the markets rallied sharply with very broad participation from these underperforming stocks. Additionally, the U.S. dollar weakened through the end of July and into August, and that could be an early sign that global growth is about to rebound. Economic conditions are improving in Asia and Europe, and a weakening dollar is further evidence that global growth might be rebounding, a view that I had held prior to the start of the pandemic. The interest rate environment remains very low, actually negative when adjusting for inflation, and the Federal Reserve Chairman Jerome Powell has made public statements that interest rates will remain lower for an extended period of time. Low interest rates have made stocks very attractive relative to bonds, and with rates likely staying lower for longer, the backdrop for stocks will remain favorable. Low rates and continued aggressive bond buying, also known as quantitative easing, is an additional source of liquidity, making stocks the favored asset class over the paltry yields that you can currently get in the bond market. We have an election coming up this fall, and it comes at a time when conditions in the U.S. are very unsettling. We are still in a recession caused by the government's necessary closure of the economy in response to a healthcare emergency. However, reopening the economy has been much more volatile and unpredictable, with progress and setbacks occurring over the process. We still have almost 3 months until the election. The Democratic opponent has picked a running mate, and the campaigning will start in earnest right after Labor Day. Now, I've spoken with many clients, and I know how difficult it is to watch the unrest in major cities around the country as long-standing racial tensions have boiled over, combined with the lack of civility between the two political parties. Even today, another stimulus bill, which in my opinion is needed, has stalled because Democrats and Republicans cannot come together to provide future support for those that need it the most. However, I am confident that cooler heads will prevail and a deal will be reached, but it adds to the confusion of why stocks are at an all-time high. As I've said before, it is the policies, not the politics, that create business opportunities. And that is what the market is focusing on. We have enormous stimulus that is going to remain in place, which continues to be supportive for equities. Americans again will be presented with a choice this election season, and we are evaluating and contrasting the policies of both candidates. We're also looking at the possibilities for the composition of the Congress. As always, with an incumbent, investors are used to the policies after 4 years. But given the unusual circumstances of this election, it is perhaps more important to understand the policies of the challenger if a change in the White House occurs. While it is early, it is clear that some priorities of the Democratic challenger are different than that of the Republican. We don't have all the answers right now, but it is likely we will see higher corporate taxes, particularly if the Senate flips to the Democrats, and that could impact corporate profits and cash available to invest back into the business. The Democrats are emphasizing new investments to move the country away from fossil fuels at a faster rate. New spending on alternative energy could impact oil and gas companies, solar energy companies, electric vehicles, and certain utilities, as well as the ecosystem of companies that supply software, semiconductors, and other products to those industries. Infrastructure is another priority of the Democratic challenger, and that could help makers of industrial equipment, aggregates companies, and commodities like copper and steel. Some industries could be negatively impacted. It is likely we will see more regulation for banks, social media, companies, and overall a greater regulatory burden on other industries. As policies become clearer, we will continue to evaluate the impact on various parts of the market. Now, we are entering a time of the year when we typically see more stock market volatility. And I know there is plenty to worry about, and the election is on everyone's mind right now. However, there are good things happening in our economy, but much will depend on progress towards treatments and vaccines for COVID-19. And I do believe we are making great strides in that area. With that said, stocks have come a long way, and this is the shortest bear market at record at around 100 days. We could see a pullback in stocks at any time and for any reason, but given the support equities are getting from low rates, sustained liquidity, and the possibility of a further stimulus bill from Congress, any weakness should be short-lived and could be an opportunity. I know it's hard to look beyond the issues we face, but I continue to see better times for our economy and for the unemployed, particularly as we get into 2021. Thank you for your support and for allowing us to serve you.
The information contained in this webcast reflects the views of Palisade Capital Management, LLC, as of the date of its original broadcast, and such views are subject to change without notice at any time. All information provided in this webcast is for informational purposes only and should not be considered investment advice or recommendation to purchase or sell any specific security. While the information presented herein, including information obtained from third parties, is believed to be reliable, no warranty is made concerning the accuracy of such information. There can be no guarantee that any forecast discussed in this webcast will be realized. Consult your financial advisor before making any financial planning or investment decisions. Past performance is not a guarantee of future results.